On March 28, 2025, a company most investors had never heard of rang the opening bell at the Nasdaq. CoreWeave was supposed to be the biggest tech IPO in years. Instead, bankers slashed the price from $55 a share to just $40, and the deal only closed because Nvidia stepped in with a $250 million order. Then, within 3 months, the stock quadrupled, and 3 former natural gas traders from New Jersey became billionaires. But underneath the AI gold rush's hottest stock sits more than $25 billion of debt, secured by computer chips that lose value faster than a new car. This is the story of the AI bubble's ticking time bomb. Welcome to Nexus of Alpha. One quick note before we begin. This video is for education and entertainment only. Nothing you hear is financial advice, and I don't know your personal situation. Before making any investment decision, please do your own research and consult a licensed financial advisor. With that said, let's get into it. CoreWeave was never a typical Silicon Valley startup. In 2017, Michael Intrater and Brian Venturo were running a small natural gas hedge fund in New Jersey when they spotted an arbitrage. Ethereum could be mined profitably using consumer graphics cards. So they filled a warehouse with GPUs and called the company Atlantic Crypto. When crypto crashed in 2018, most miners went bankrupt. Atlantic Crypto did the opposite. It bought even more GPUs from desperate miners for pennies on the dollar, betting the chips were valuable even if crypto wasn't. Rebranded as CoreWeave, it quietly rented out its fleet for visual effects rendering. In 2022, revenue was just $16 million, roughly what Microsoft books in 20 minutes. Then ChatGPT launched, and suddenly the entire world needed one thing above all else: Nvidia GPUs, in quantities nobody could get. CoreWeave, a company that had spent 5 years doing nothing but hoarding and operating GPUs, was accidentally sitting on the most valuable commodity of the decade. Revenue exploded from $16 million to $229 million in 2023 to $1.9 billion in 2024 on paper, one of the fastest growing companies in the history of capitalism. The problem? Growth like that has to be paid for, and CoreWeave found the money the hedge fund way. Every gold rush has someone selling shovels, and in this one, that's Nvidia. But with CoreWeave, Nvidia isn't just the supplier. Map out the relationship, and it starts to look like a circle. First, Nvidia is a shareholder. It invested before the IPO anchored the offering itself, and then in January 2026 bought $2 billion more of CoreWeave stock in a private placement at $87.20 a share. Second, Nvidia is the critical supplier. In CoreWeave's own words, every single GPU in its infrastructure today is an Nvidia GPU, and its customers contractually require it. Why does Nvidia favor them? Because Amazon, Google, and Microsoft are all building their own AI chips to escape Nvidia's margins. CoreWeave never will. Every dollar it raises flows straight back to Nvidia. And third, Nvidia is also CoreWeave's customer, reportedly committing billions to rent capacity back, effectively guaranteeing to buy whatever CoreWeave can't sell. Think about what that means. Nvidia invests in CoreWeave. CoreWeave uses that money to buy Nvidia chips, which Nvidia books as revenue. And if nobody rents those chips, Nvidia becomes the renter of last resort. If this sounds familiar, it should. In the dot-com bubble, telecom giants financed their own customers' equipment purchases. It inflated revenue beautifully, right up until the customers collapsed and took the vendors down with them. So how did CoreWeave actually pay for hundreds of thousands of chips costing up to $40,000 each? Leverage. Starting in 2023, CoreWeave pioneered borrowing billions of dollars using the GPUs themselves as collateral. By March 2026, that borrowing had reached $25.1 billion of principal, up from $21.6 billion just 3 months earlier. And this is not cheap money. Its delayed draw term loans carry effective interest rates ranging from 7 to 15%. Its senior notes and its equipment financing sit at 10. A loan from Magnetar Capital, the hedge fund famous for its trades in the 2008 mortgage crisis, costs 12. Compare that to an investment-grade company, which borrows at around 5. In the first quarter of 2026 alone, interest expense was $536 million. Annualize that, and CoreWeave is paying over $2 billion a year just to service its debt, more than a quarter of every dollar of revenue it takes in. Why so expensive? Because the lenders understand exactly what the collateral is. A GPU is not a building. The moment Nvidia ships a new chip generation, which it now does every couple of years, on purpose, the old chips crater in value. Lending against GPUs is like lending against fresh fish, and that exposes the most important accounting assumption in the entire AI industry: depreciation. How long is a graphics card actually worth something? Stretch that estimate by even a year or two, and billions of dollars of losses quietly disappear into the future. And who's renting all this capacity? Very few people. In the first quarter of 2026, one single customer accounted for 45% of CoreWeave's revenue. A second accounted for another 20%. A year earlier, one customer alone was 72% of the business. That is improving, but losing one client would still be catastrophic, while $25 billion of debt would remain exactly where it is. The commitments are enormous. OpenAI has agreed to pay up to $11.9 billion through 2030 and a further $6.5 billion through 2031. Meta has committed up to $21 billion running through 2032. But look closely at who is promising to pay. OpenAI loses billions of dollars every year and has pledged over $1 trillion of future computing spend across the industry. That is money it does not currently have. Now consider Core Scientific. It is a data center operator, and in practice, CoreWeave's landlord. It physically houses a large share of the capacity CoreWeave rents out. In 2025, CoreWeave tried to buy it for around $9 billion and, crucially, offered to pay in its own shares rather than cash. Owning its landlord would have locked in power, space, and cost for a decade. Core Scientific's shareholders voted it down. That carries two signals for investors. The first is strategic. CoreWeave still does not own the ground its business sits on, so its landlord can renegotiate. The second is sharper. Management asked the market to accept CoreWeave equity as money, and the market declined. When a Bitcoin miner would rather keep its own business than hold your shares, that is a verdict on what your currency is worth. Add $40 billion of lease commitments that have not yet begun, and a quarterly net loss of $740 million, and every link in this chain becomes somebody's asset and somebody else's liability. So, is CoreWeave a fraud? No. The data centers are real, the customers are real, and the founders saw the GPU shortage coming before almost anyone. There are two honest ways to read this business. The bull case is straightforward. Demand for computing power still exceeds supply. CoreWeave's data centers are full. Its contracts are signed with some of the largest technology companies on Earth, and as those contracts convert into cash, the debt gets refinanced on steadily better terms. The bear case is equally simple. Growth pauses for even a year. The chips age. The interest keeps compounding, and the losses land not on shareholders, but on the credit markets that funded them. Which case is right depends almost entirely on one variable: time. CoreWeave is the load-bearing wall of the AI bubble's financial architecture. Nvidia's circular revenue, OpenAI's unfunded promises, and Wall Street's GPU collateralized debt all intersect on its balance sheet. And here's the uncomfortable part. You don't need AI to fail for CoreWeave to fail. You just need the growth to pause. For Microsoft, a pause is an inconvenience. For a company paying over $2 billion a year in interest on chips that depreciate, it could be fatal. Remember, none of this is financial advice, so always consult a licensed professional before making investment decisions. If you enjoyed this deep dive, subscribe to Nexus of Alpha for more. Until next time.